Today we're going to introduce you to Tammy Bell. She is a nurse in the Sacramento area. She's got 2 kids and she is looking to buy a home. As always, I got Aaron. We're going to talk about a little bit of her scenario and about Tammy specifically, her needs, if she can make it happen and whatnot. How's it going, Aaron?
Hey, what's going on, brother? Well, let's dive into Tammy the nurse.
All right, so she's single, but she's not really. She's getting a divorce right now, so she's technically married. She's a registered nurse. Her credit is 670. W-2. Gross salary is $120,000 a year. In the bank, she's got $50,000. DTI is 34%. Additional details. Bankruptcy 5 years ago. Additional detail. Major overtime opportunities allowed to her. So we got to factor that in. Additional, she is getting divorced. She's not divorced, so she's technically married. That could be a problem. And then the last thing is that she's only been at her current job for 3 months, but has worked for various hospitals for the last 3 years. All right, Aaron, let's get into it. What are we looking at?
Yeah, so right out of the gate, the 670 FICO, one of the things that I'm going to want to look at is whether or not an FHA loan makes more sense than a conventional loan, because conventional loans, they care more so about your FICO score as in terms of the interest rate and the cost of PMI if you're going to have PMI. But as you know, Mark, some agents and some sellers view FHA loans inferior to, conventional loans. So ideally, we're going to want to get Tammy a conventional loan, assuming that everything pencils, because that'll make her offer much more competitive. Being a W-2 employee, that definitely, makes things a little more simpler. I mean, not that being self-employed is a deal killer by any means. It's just that, instead of having to document tax returns and, P&Ls and things like that, we're just going to use her pay stubs and W-2s. So really, really simple stuff there. With her income amount, she is going to have a lot of options, especially in the greater Sacramento area and kind of where she's, where she wanted to be at, basically, somewhere that's, not impossible to get to downtown Sacramento. Right. And then, of course, she's got 50 grand to work with. So we've got some options in terms of down payments, maybe potentially, buying the rate down. So we've got some options in terms of meeting her goals. As far as the additional, things that, could potentially be a challenge, for her to get a home loan, the bankruptcy 5 years ago, having a BK is not a deal killer when it comes to getting a mortgage. However, certain types of mortgages have a certain amount of time that is required between when you had the bankruptcy and when you're getting the mortgage. Now, fortunately for Tammy, 5 years is more than all the types of loan requirements. So basically, once you're at 4 years or more, you're going to be eligible for pretty much everything, out there. So that checks off the box. We don't really have to worry about that. The overtime opportunity, there's kind of 2 moving parts there. One of them, of course, is, do we use overtime to qualify her for the loan? And, whether or not we do just, comes down to what we have to document. But also that provides Tammy with some flexibility in her budget. Often when I talk to people about their budget for the house, a lot of people are working on, they've got like a fixed salary. A lot of people, especially in the Sacramento area, like 1 out of 5 work for the state pretty much. I mean, all you state workers out there, you get 1 paycheck a month. You don't have the opportunity to work overtime, all that. So you've got a fixed budget. Whereas like Tammy, she's got an ideal budget, and obviously everybody's got to work within her means, but she's a little more flexible because of what she does for a living. Short of becoming a vampire, the hospital would let her work, unlimited overtime potentially. So she does have a little bit of wiggle room as far as that goes. Now, the thing that I would say is the biggest challenge that we need to, overcome in this scenario is that, Tammy is in the process of getting divorced, very, very common. However, California is a community property state. Okay. And when it comes to real estate transactions, um, Tammy's, soon to be ex, he either needs to sign off on it or he's going to become owner of this property. And I mean, let's be real, right? Who wants to, go into, ownership on a new property with somebody that you're splitting away from, right?
Right.
So ideally, this is something that, if you found yourself in the same situation that Tammy's in, you would want to address it up front, which is, by the way, what we did with Tammy. We brought all this to her attention and she was able to talk to her ex. And fortunately, they're, very amicable and on, good terms. And so, he had agreed to basically sign a quit claim deed, which is a document that basically he's given up his rights to his spousal rights to the property. So addressing that ahead of time was crucial, not only to just have a smooth transaction and as far as all that stuff goes, but typically if you didn't address that ahead of time, most likely this isn't going to become a problem until you're in like week 3 or week 4 of a potentially 4-week escrow. And so finding out, in the second half of the game that now all of a sudden you've got this ex that has a legal right to something and that has to sign something in order for, the deal to close, that's not when you want to be problem solving that and working it out. I've, over the last 20 plus years of doing this, I've literally helped dozens and dozens and dozens of people in this scenario. And 9 times out of 10, it's okay. We're able to get through it, but it's those times were always, when we addressed it ahead of time, and either, the amicable soon to be exes were able to just, be fine and work things out, or, for those that kind of had a more tumultuous, exit, they were able to negotiate and basically get commitments. We've even had their attorneys, like work through the attorneys to have the attorneys get the verbal commitments and all of those things, so that at the end of the day, you're not in escrow and have this thing blow up on you, basically.
But basically,
And
like
then,
what you're saying is, well, let me just get this right though. As
yeah,
far as like how the loan is going to be structured, is she's going to need her husband, technically that's what he still is, to qualify for the loan. So that's taking into account his credit, any negative, all the DTIs and all that kind of stuff too. He's not going to be on the loan, but unless he signs a quick claim like deed, he will be on the deed. So he won't really have to pay off the house. He'll be on the deed unless you get that settled beforehand, correct?
yeah. So he would not be a borrower on the loan. However, one of the things that, we were talking about in the beginning of this in terms of our like consideration of what programs to look at for Tammy, FHA, because of the lower FICO score, is something that potentially would get her a better deal. Basically, it would be a cheaper option. However, FHA and VA, USDA loans, any government loan, in a community property state where the transactions, located in a community property state, such as California, we would have to include Tammy's ex-husband's monthly debts in her debt to income ratio, even though he's not on the loan. So that's an added layer in the whole. We've had it happen, not with Tammy's scenario, but just with clients over the years, where they do the application with us, and during the application process they tell us that they're already divorced, or something like that. They don't basically give the full story of the ex situation. And then what happens is when you go into escrow, one of the jobs of the escrow and title company, they're basically ensuring the chain of ownership and title. And so they're going to make sure that the people that are on title are actually the people, that they're real people, that it's them. And so there's a very standardized form called a statement of information, but basically it's like a deeper dive into like almost a verification of who you are. So during those processes, and also like in credit checks and stuff like that, there are times where it's going to come up. The skeleton's going to come out of the closet, and the lender or escrow is going to find out that there's this X that exists, and then all of a sudden you got to address that. Now, like we said, with Tammy's situation, we knew about this right out of the gate. We were able to, provide a solution out of the gate. But, that is something that if, you don't want your lender or the escrow officer or whatever be the one that discovers that. Let them know ahead of time so that they can structure your loan the right way, structure your financing the right way. And, even if the qualifying for the loan is no big deal, you're a baller, you make tons of money, DTI is not a big deal, you still got the whole community property thing to work out. So you definitely want to address those things up front before, you're under contract and have a limited amount of time to do this.
Okay, well, Tammy is in a good situation. Her
Mm-hmm.
ex is like they have shared children. He wants them to have a house, place to
Yep.
grow up, yard, and the whole that thing. So they're not a problem, and she's pretty confident. But again, that's her decision, and she's telling us what she's telling us. So that's it.
Sure.
So that one's all taken care of. Let's just say in this transaction. So the additional other one is job wise. Okay, she's been at this job for 3 months, but she has been in the same industry for 3 years at various hospitals. How does that work?
Yeah, so switching jobs is not a big deal. As long as you're not going from one completely different industry to another completely different industry, and you're also trying to use like a new type of income. Like maybe let's say you were a salaried employee with the state, and then now all of a sudden you're a 100% commission salesperson or something like. I mean, that's going to be a problem. In Tammy's situation, though, she went from one hospital to another hospital and then to another hospital. Basically getting, she was up in her income. Basically, she makes a lot more with UC Davis versus the previous hospitals. So switching, employers, not a big deal. Having gaps in your employment, meaning like I ended with this employer and I started with the next employer, the time in between those two dates, that's called an employment gap. Employment gaps within reason are not a big deal. If you have like an extensive employment gap, you're like 6 months or something like that, then we're going to have to really, do some extensive documentation of and explaining, why was there a gap, all of that stuff. But in Tammy's situation, it wasn't even 30 days really. But one of the things that has to be considered is, like we talked about, Tammy has the potential for unlimited overtime. So part of her income, she's a nurse, she works crazy hours and she earns overtime. Well, the way that overtime is calculated when you're getting a mortgage is that it's averaged out over the last 24 months. So if you have gaps in your employment, those are also goose eggs of your overtime average over that 24-month period. So depending on, what you were making previously, which is usually less, along with those gaps, that can kind of drag your overtime average down. So it could hurt qualifying for some people. In Tammy's scenario, her DTI was still, relatively low to, to what she earned and all of that stuff. So it ended up that, no big deal. But, one of the things I will mention is, since we're talking about changing employers, is if you are pre-approved for a mortgage or you are in the process of getting a mortgage and also you are now going to switch employers, make sure to coordinate that with your loan officer, with your real estate agent. Make sure everybody's on the same page, because that could cause delays, bumps in the road, and all that stuff. And you want to make sure that you get all that worked out ahead of time before, you're under the gun, under contract, and, you got a deposit that you might lose or whatever. But, Tammy, we were able to basically check off all the boxes. We were able to overcome all of her, hurdles, the previous bankruptcy, the situation with her ex, being in the process of being divorced and not actually being divorced, basically. And then, switching jobs. A lot of people switch jobs pretty frequently to increase their, economic opportunity. So that didn't stop Tammy from buying a house.
Okay, so Aaron does his due diligence with Tammy. He goes through everything. And basically, I have a call with Tammy, and she says, hey, look, I work at UC Davis Medical Center. I need to be close by. You got to drop the kids off and everything, too. So we're looking at various locations. Elk Grove is one of those spots that I'd say, like, okay, it can be done. And I'm talking to her about new homes and resale, because that's usually the conversation we have. She's against new homes. She doesn't want to pay the Melrose, especially in Elk Grove, North Natomas, and the Natomas area. They're not really building that many homes. So she says, I would like to look at resale. That's where I'm looking at. I don't want to deal with a landscaping backyard. I don't want to deal with the Melrose costs that we're seeing in Elk Grove. So Tammy tells me that specifically. So I say, okay, look, for what she's looking at, and I'm looking around because she's looking for a 3-bedroom, 2-bath, and she's looking to keep it under 2,000 square feet. So then my next call, of course, is to Aaron. I say, okay, Aaron, what are we looking at? What is she pre-approved for? Are there any curveballs? And this is kind of how the conversation would go. Aaron, how are we doing with Tammy? Is there anything I should be aware of? What are you thinking?
Yeah. So with Tammy, we are going to want to keep her sales price at or below $600,000. Her goal, like her, ideal monthly budget was $4,000 a month when we include, taxes, insurance, all that stuff. If you keep her under 600,000, that gives me a little bit of a buffer, a little bit of wiggle room. I wasn't sure if she was going to end up in a neighborhood with, HOA dues or flood, or, you'd mentioned, I think, Natomas potentially. So, I mean,
Yep.
There could be flood. So she's got a little bit of wiggle room, but one of the things that she and I did talk about, and I told her, it all comes down to the seller's situation, and obviously, how much demand there is for the property and all of that stuff. But she is aware of what a temporary buy down is. And although she doesn't have to have it in order to meet her kind of top line budget goal, if she was able to get a 2-1 buy down, for instance, that would put her well under her budget goal for the first year, and really kind of help her ease into home ownership. And so that would kind of be like the icing on the cake for her. So in order for you to be able to pull that off, basically, you'd need roughly a 2% seller credit. After, with her whole scenario and everything, because she's not legally divorced from the ex, with the debt to income ratio, even though she does make really good money, the ex has his own debts and everything. So doing an FHA loan just didn't pencil that way regardless. So it's going to be a conventional loan. So that should help your offer as far as things go. We can close quick if needed. I don't know. That's more of your expertise on what's going to be needed. But, as far as speed goes, she's definitely in a position to do a fast close.
Okay. So as far as the buy down goes, what's the bottom line on what I need to get for her buy down, if I can get it?
If you can get it, just call it 2% of the sales price. That would cover it.
Okay, good. All right, so at this point in time, we're going to be, Elk Grove is a very competitive market right now. In fact, what we're normally seeing is Elk Grove stuff flies off the shelf. And in that type of market, in a hardcore seller's market, what you end up seeing is that they're not really apt to negotiate a little bit of a seller credit or whatnot. Not to mention anything in Elk Grove that is sitting usually is overpriced, and therefore you're going to run into appraisal issues. Even if you keep the appraisal contingency intact, which we plan on doing, it's still a harder thing to sell because the realtors are like, yeah, I think it might go over the appraised or under the appraised value. So, you got to waive the appraisal contingency. And we don't want to put Tammy in that situation. So we switch gears and we would look at North Natomas. North Natomas still is striking distance to UC Davis Medical Center. Yes, you have to consider flood insurance, but that's a FEMA thing. About $80 to $100 a month on flood insurance. With resale, you're probably going to pay little to no metal roofs as well as North Natomas goes. Now, we found a couple houses that might work for her. Now, we can't look at really the houses that are just hitting the market because a lot of realtors aren't going to want to negotiate seller credits. Their house is like the new kid in town where everyone's putting attention to it. The idea of trying to work a seller credit or anything like that just doesn't work when something is right, fresh, hot off the presses. Now, Natomas, as we mentioned, is close to the Sacramento area. So like I said, striking distance. So we go out and show Tammy some homes in Natomas after getting a nice little briefing from Erin telling us a little bit about what she needs, what she wants. Now, we're not even sure we can get that in Natomas because it's still a very hardcore seller's market, but we're looking around and we're seeing a nice variety and assortment of 3 and 2s in North Natomas. We're even throwing in a few Elk Groves as well in other areas that might work for her. But after seeing North Natomas, after seeing the bang for your buck, Tammy is sold on North Natomas. She's like, I love it. It's close to downtown. You know, I have a couple friends here. We're good. So we go out, we do a nice little tour for her in North Natomas, focusing on maybe 4 houses that she's seen with our Sacramento real estate app that she absolutely loves. Now, the one she settles on is the one that makes me smile because we're looking at this house right here. Now, as far as the CMA that we ran, it's actually a house that's valued at around maybe $550. So this is pretty nice, right? So it's a little bit higher value. So we can actually go in there. Now, it's been on the market for about like 14 days. So we're in striking distance. At 14 days in the hardcore seller's market, things need to fly, especially in this price point. This is the hot price point in the Sacramento area. So if this thing hasn't moved in a week and a half, between like 450 and 600 is a hot price point. This thing is sitting for some sort of reason, and we have an advantage now because we could actually write up an offer for, let's say, 550, 500, whatever Erin basically needs to get her that temporary buy down. And then what we can end up doing is having a seller credit back. So we're giving the seller more than they're asking for the house, but we're building into the contract a buyback and a seller's credit. So it's basically we are paying $539 for the house, but we are building in a credit. Now, here's where it gets fun, and this is the interesting part. Because this thing has been on the market a while, we might not even offer like $539. We might actually offer like $530 and then add the seller credit. So we're out the door at maybe like, I don't know, $545 or something, because this and she loves the home. So one is she loves the home, and strategically this house has been on the market. So the listing agent and the seller are a little bit more like up for the conversation of a seller credit, maybe even a longer close if we need to, which we don't. And so this is the house we're looking at right now. Again, 1582, it's a little smaller, the square footage that she liked, but she loves the finishes, loves the location, and this is the house for her. Then I have the conversation with Erin. Okay, so this is the house for her. I'm going to write it up. I'm going to see if I can get you maybe like, what are we talking? Maybe just to keep it safe, like $11,000 seller credit. So we're going to write this thing up for maybe like 541. And, we're going to write it up for 531, and then we're going to maybe do an additional $10,000, $11,000 seller credit for you. Does that work?
Yeah, no, that'll pay for that temporary buy down and get Tammy, her icing on the cake goal monthly payment. So that'd be perfect. And the only thing that I would add is as far as contingencies go, I would just, if possible, I would try and keep the appraisal contingency, but maybe you shorten it up. We could do, if that's even a deal, a thing for the seller, we could shorten up the contingency instead of 14 days. We could do 10 or 7 or something like that. But to where we could get that report in our hands before she has to remove those contingencies, since we're kind of trying to bake in a seller credit into the price. But that's a perfect strategy, man.
Well, the other thing too is because the house is kind of like sitting on the market too, we would never waive the appraisal contingencies. In this situation, we have a lot of leverage, especially if it has no offers and everything too. So the appraisal contingency is intact. And honestly, we don't even have to shorten down the escrow unless Tammy's like dying to get into this house. If we can have additional time, it's good for us anyways. If the inspections pull up anything or whatnot, it's good. So this one I would normally write up a maybe 30-day escrow, keep the appraisal contingency intact, loan intact. Perfect. Inspections do about 10 days. I can get the inspectors out in 3 days and we're good to go. Erin, how does that look for you?
Oh, this is a slam dunk. We just need that offer accepted and this thing's closed.
All right, guys. So this is kind of like Tammy Bell's story on how she got into her house, and this is kind of a current, like this is a kind of like example of what we run into all the time in the Sacramento area. There are always going to be hurdles, speed bumps on your way to the finish line of getting your house, but it's doable. I would say reach out to Aaron. Reach out to myself, talk to us a little bit about your situation. And we have not found a situation we couldn't beat. Maybe you can't buy this moment, but maybe in 6 months to a year you can. But you definitely need to talk to someone, because there isn't a situation that, I mean, I've seen every situation in the sun. Aaron definitely has too. Aaron, any parting words for everyone listening?
Yeah, just make sure to like, comment, subscribe, and we'll see you next week.
All right, guys, have a good one. Tammy Bell's story. She got the house. Her house is, the kids are happy. Everyone's happy. And if you like this video specifically, you'll like this one right up here or that one over there. Until next time, guys, this is Mark and Aaron. We're out of here.